Have you ever heard anyone talk about whole life policies compared to IUL and how they say cost of insurance goes up over time, so IUL is going to eat itself. The cost of insurance is going to make the policy lapse as they get older. Well, we're going to take about 5 minutes to see if that's really the case here. So bear with me for about 5 minutes, hopefully. And if I don't go off on a tangent, we'll be done in 5 minutes. Otherwise, it might be a little longer, but this is a 34-year-old non-tobacco female who is putting $1,000 a month into her policy for a total of $12,000 a year. So total outlay of $120,000 over 10 years. And after that, as you can see here, years 11 forward, premiums are zero. So 120,000 for 10 years. She ends up with a death benefit of 461,943. So after the client stops paying, I level the death benefit so that it doesn't keep going up. As you can see here, over these 10 years, as the premiums are being paid, the death benefit is going up. Well, once you stop paying the premiums, you're going to make interest on your policy, hopefully, and that's going to make the death benefit go up unless we level it. We want to level it so that the cost of insurance doesn't continue to climb for the client. So by leveling the death benefit, we are allowing this column right here, the cash value, to keep increasing based on the interest being accumulated, which is illustrated at 5.99% right here. Nothing crazy. If you've got a 20 or 30-year time horizon, the S&P 500 definitely does better than 6%. I think it's just over 7 over the last 20 years from 2002 to 2023. But anyway, just illustrating conservatively 6%, which is similar to a whole life policy. So I'm going to clear all this out and show you that this policy's death benefit does go up a little bit again, right about here. And that's because the IRS says if we want to keep this as a life insurance policy, there has to be a corridor, as they call it, between the account value and cash value and the death benefit. So as you're older, that corridor gets smaller, but when you're younger, it's big to start with. So it starts off kind of like a funnel. It's big and it gets smaller. So it allows over time the death benefit to get closer to the actual cash value and account value of the policy, but only so close. And at that point, the death benefit has to go up again to stay within that corridor of the account value. So that's what you're seeing here, right about year 60. Right here, we went up from 461 to 474, and that's because the cash value was getting too close to the death benefit. So another thing to keep in mind is a lot of people don't realize the amount of insurance that you're paying for as a client is not this 474,519 right here. It's the difference between this death benefit of 474,519 and the 354,118, which is your cash value and account value. So that's roughly $120,000. So this person at 60 years old is really not paying for 474,519 of death benefit. They're paying for about $120,000 of death benefit, and that's because that's the amount of risk for the insurance carrier. Okay, it's not the full 474,000. That would mean you had no cash value, no account value here. So keeping that in mind, we're going to go to the other pages. Scroll down, I think it's page 24, where the expenses and the interest start to show. Yes, okay, so and again, as illustrated at 5.99%, nothing crazy. Same $120,000 outlay. Here's your total expenses for the year. This is your cost of insurance column that everybody talks about. That's going to go up so much when we get older that it'll eat the policy, that the policy will lapse, et cetera, et cetera. That can happen if the policy is not properly structured and or properly funded. But if you are meeting with your agent annually, your agent should be making sure that that's not happening. And if you're not meeting with your agent annually, call your agent and make sure that you set up an annual meeting. So the cost of insurance right here, as we said, years 1 through 10, when she's making the premium payments, pretty cheap, okay, because she's young. Started off at 34 years old. She's only 44 years old at the end of year 10. She's paying $254 a year for insurance, and these other charges make up this annual total right here. So first 10 years of a policy, very honest with you, those first 10 years have the highest charges. That's because the insurance company has the most risk, honestly. Because if you die at year 2, you've put in $24,000 to this policy. Well, they're on the hook for almost $350,000 to pay out to your beneficiary. So the first 10 years are the highest in expenses, and this average right here is about $2,000 a year over these 10 years. As you can see, when we go further down, after she has stopped paying in the policy, the expenses also go down. So right here, we are starting with year 21 through year 30. And look, the expenses are roughly $550, $600 a year. So yeah, because there's a $6,000 difference between this $25,000 here, oops, and this $31,000 here. So we paid about another $6,000 in expenses for these 10 years. So roughly $600 a year. Now, the cost of insurance column is still right here. Keep that in mind. She's 55 to 64 years old. Her cost of insurance is, roughly $500 a month plus her expense. So again, about $600 a year. And look at her death benefit. She's got $461,943 when she's 55. When she's 64, she has well over $500,000. So I have to ask you, if you're 64 years old and you have over $500,000 of death benefit, do you think that spending $600 a year is a lot of money for insurance? Because I would say no. And again, this assumes the policy is structured properly, that it's funded properly, and the client isn't letting a loan continue to accrue loan interest year after year after year, because that certainly would eat into the policy. But again, just wanted to show people that the cost of insurance, yes, it does go up over time, but it's very affordable if the policy is structured properly. So if it's done this way, where you level the death benefit and you let the cash value, account value grow and catch up to the death benefit and get within that as close to the corridor as you can, then the amount of insurance you're paying for becomes very minimal. So in this case right here, where she's got, $762,694 death benefit, and this is the account value and cash value, well, she's paying for like $100,000 of insurance, really. And she's 70 years old. And that cost of insurance is $870 plus this expense charge. So total annual expense, $978. So, I want someone to show me where you can give a policy to a 70-year-old for $750,000, over that actually, and have them pay, less than $100 a month for that insurance, because that's what happens if this is structured properly and if it's managed properly. Those are big ifs, I know, but your agent should be meeting with you annually to make sure that you are on track for your goals that you initially set up with the agent in the first place. And if you're not, then some changes need to be made to make sure that your policy does stay funded, so that you do have the values that you anticipated and the death benefit that you needed. So I hope that helps. If you found this helpful, please subscribe to my channel, and I'll see you in the next one.